2022 was not a good year for stock investors, bond investors, or just about any investor in general. And it had many people questioning the good old 60% in stocks, 40% in bonds rule that most people follow. Let's get some common sense now from Craig Bolanos, CEO and founder of WMG. What can you tell us about a possible investing shift?
Well, Angie, many investors continue to use the portfolio strategy that everyone has dubbed in the industry 60-40. It was developed by a Nobel laureate, Harry Markowitz, back in 1952. And you know what? For good reason. It's provided investors with attractive returns while assuming a reasonable risk profile, thus making it a favored strategy of both individual and institutions alike. However, yes, 2022 wasn't a good year for the 60-40 strategy due to the concurrent headwinds that rising rates had on both equity valuations and traditional bond funds.
Craig, tell us about some ways to pump up bond investing, especially as rates are now higher than a year ago.
Well, Angie, that's a good follow-up question. Most investors access their bonds through simple bond mutual funds. And these are great because you get instant diversification, professional management, and often it comes packaged at a very reasonable cost. However, most bond funds pursue something we call a perpetual NAV, perpetual NAV. And as a result, they might just be subject to more interest rate risk over time. Hence, we want to reintroduce everyone who's owning bond funds, not just to the vehicle of mutual funds, but through the construction that incorporates some different strategies. And the first is we've already been starting to layer in some level of what I call bond ladders with individual bonds for clients, because when you're building a bond ladder with individual bonds, it really can in fact help mitigate interest rate risk by allowing the reinvestment of periodic bonds at new current rates. It also reduces concentration risk because you hold different issues, different maturities, thus creating diversification in the portfolio and income. And of course, it gives you more liquidity. By owning individual bonds at different maturities, you know with certainty when you're going to be getting your principal back, thus allowing you to plan more precisely for future life events. So in addition to those bond mutual funds, incorporate individual bonds to create a ladder. And I would argue there's a third step that we've been doing at the Wealth Management Group, which is utilizing bond ETFs with defined maturities. So you can further diversify your traditional bond funds, not just with individual bonds in a ladder, but by owning bond ETFs that have a defined maturity date as opposed to a perpetual NAV. And if you create a bond ladder, AKA bonds maturing in 2026, 2027, 2028, again, the value is you're getting 1/3 of your principal, your par value back every 3 years. And when you add bond ETFs such as December 31st, 2026, December 31st, 2027, December 31st, 2028. It's the same concept. You've got a diversified basket and you know exactly when your money is maturing, December 31st of the ensuing year. So what's all this mean? It's a lot of stuff, but the bottom line is if you're a 60-40 investor of some subset thereof, it's imperative in today's environment of potentially rising rates further, given the inflation, CPI, and PCE has recently spiked higher, that you consider incorporating not just traditional bond funds, but bond ETFs with defined maturities. And I think after the Fed is done with some additional rate hikes this year, really looking to go into some individual bonds with bond ladders is going to help create permanence and definition into the safe portion of your capital, the ballast that is bonds. And that's mission critical. If you want to learn more, I encourage you to do so. And here's a way that you can. Go out to our website. That's investwithwmg.com. I'm Craig Bolanos. We're here to help you get retired and stay retired.
Go to businessfirstam.com for where to see our show on TV.